Yeah, I think the first question everybody has on their mind when they think of you is like, what is the pulse of the economic recovery story you're seeing sitting in the United States with the kind of recovery path, let's say the US is taken versus one the emerging markets is taking, just the big picture?
So the big picture to me is it is distinct, right? What's happening in the US and even within emerging markets, I wouldn't put them all together because it's country by country. This has been a very, very different and difficult crisis around the world. The US, in some ways, has had what I would consider a classic V-shaped recovery. We had a complete collapse of the US economy. This time last year, we were emerging from a quarter where in annualized terms, GDP shrank by almost a third. Now, that was, of course, shocking. But at that point, people were anticipating maybe, the alphabet soup of recoveries. Would it be L, K, V? What was it going to look like? We were always a bit more optimistic in terms of how the US recovery would look, in large part because the US has the luxury of being able to throw a massive amount of policy support at the recovery. We had a huge expansion of the fiscal deficit. To put things in perspective, it's the largest expansion since the Second World War. We're talking about a budget deficit just enormous, massive monetary stimulus. And then to top it all off, we did get the vaccines. So you put it all together. And despite the recent concern about Delta, Lambda, Mu, there are many different COVID variants around. I do think I still remain pretty optimistic about the outlook for the US. You might have slight delays in terms of further recovery, but I think we'll see them. If I look at emerging markets, the story is a much more varied one. For example, in India, I think the recent pickup in daily vaccination rates is something which is very reassuring, because ultimately, I think this is on path. COVID is on path to be moved from being a pandemic to being endemic. What I mean by that is flu comes every year. And of course, people get vaccinated if they have particular vulnerabilities. And it increasingly looks like that is the direction COVID is going in. And from the Indian economy perspective, I think that we will continue to see a recovery on the back of this. Reopening is the trick, getting us to the stage where economies can reopen. Yeah. No reopening, no growth.
So it's interesting that you mentioned that a great deal of this, as you yourself said at some point, was the kind of central bank behavior we've seen. How much of that, from a policy decision-making point of view, will change the pattern of this recovery? And maybe it's worth looking at the way you did earlier, US, Europe, and down here.
So, if I look at central banks, again, central banks come from different places. The US and other developed economies such as the Eurozone or even Japan, there is a massive degree of flexibility. Let's face it, there is a difference. They essentially are able to import and export in their own currency. And essentially, they have less reason to be concerned about issues such as levels of reserves. Emerging markets broadly need to worry about issues like that. Now, in the case of the US, and if I look at monetary policy in general over here, and I look at what the Fed achieved immediately after the inception, if you will, of the crisis and the lockdowns, it was perfect monetary policy conduct. However, what was perfect then, to me, is not perfect today. We're looking at an economy today which is likely to grow at Chinese growth rates. This is the US. This is a developed country. Yeah. There's no so the fact that we've made up all of those output gaps as quickly as we have, the fact that in nominal terms GDP has blown through its pre-COVID path, nominal terms, which means it's coming from inflation, does give me pause. So what was perfect policy making from the Fed in March of 2020 is actually excessively loose as I sit here today in September of 2021. We're looking at an economy that's growing in high single digits. It doesn't need the Fed being in the market buying $120 billion worth of treasury bonds every single month. Essentially, the country is flush with the system, markets are flush with liquidity, and we are seeing a very predictable response from prices. Inflation is picking up. Yeah. So I think that these are the things which one needs to consider. Similarly, actually, if I look at the Eurozone, to a much smaller degree, you started seeing some pickup in inflation. But the big difference, you never saw the fiscal expansion in the Eurozone that you saw in the US. And then if I look at emerging markets, in fact, many emerging markets have actually started to reverse some of their monetary easing. Here I'm looking at some countries in Latin America, for example. You're seeing a reversal of those policies because inflation is a very cruel tax in countries which are not wealthy. And so I think the constraints are greater in EM than they are in DM.
For sure. And I think we've been having those conversations here at Perspectives with many other, economists and speakers as well. So my question would be that to you, in such special circumstances, post-lockdown, in the middle of COVID still, why would you not give up the inflation concern in favor of growth?
I would say that here, let me focus a little bit on the US for the moment, and to some extent to other countries. Now, the issue about inflation is fascinating. The Fed has actually had a relatively easy time of it in the post-global financial crisis period. So in the post-2007-8 period, inflation has been very low, and the Fed has run very easy monetary policy, and that worked. There was no pickup in inflation. The issue was that we didn't have fiscal policy at the same time. So I think what my concern would be is the combination of very, very loose fiscal policy. I mean, in the US, we spent trillions last year. We're talking about a few more trillion potentially in the period coming ahead. Again, I would repeat, all this coming after our real GDP has gone back to levels it was pre-COVID. And in nominal terms, so nominal GDP, because of the quantity of inflation which is building in the system, we are exceeding the path of pre-GFC, pre-COVID nominal GDP path. Now, why does it matter? Well, inflation is a funny thing. It's a tricky thing because it depends. What happens with inflation is inflation expectations determine what inflation will be. If I expect inflation as somebody who is negotiating a wage, if I expect inflation to be 5% higher next year and my boss gives me a 3% raise, I'm not going to be very satisfied. Now, if you push for a 5 to 6% raise instead, at this stage, what happens to your employer? Your employer needs to raise prices. And indeed, pricing power is increasing because consumers have a lot of cash coming from the government, and they're in a position where they can bargain for better wages, which in principle is a good thing, don't get me wrong, but you do need to have the output to support that. And right now, what we are seeing is, in fact, the highest divergence between the number of job openings and the number of unemployed. In a sense, massive amount of job openings. People don't want to look for work. So if you look at that combination, it's not a healthy development in the economy. So those are the reasons I would say at this stage, growth is doing just fine. You don't need to worry about growth. So the monetary policy is in a position to take a step back and allow fiscal policy to continue doing what it is.
Sonal, just looking at the entire talk about cues for the markets. So could they be looking at Biden's 2 trillion plus spending package? What cues may that have for a medium to long-term growth story, given that a lot of people are saying this package could be more short-term than long-term?
Given that it is short-term, and given that, in fact, what Biden wants is 3.5 trillion, I don't think he gets it, but he wants 3.5 trillion and another 1 trillion in infrastructure. You're looking at 4.5 trillion. These are huge numbers. Even for the United States, 4.5 trillion is a massive amount. Now, it's all not going to come in this year and next year, but however much comes in, it's almost too much. Already you can tell because the country is not needing this quite right now. It's already booming. You've already got supply bottlenecks and so on. And it will create issues. Now, then the question comes, what about infrastructure? Isn't infrastructure a good thing? Shouldn't we all want some spending in infrastructure? It delivers future growth. And here I would note something which is infrastructure is often used as, you don't have to worry about infrastructure. It pays for itself in future growth. I want to note there is a big difference between, for example, a 5-lane super highway in the US, and your infrastructure spending takes you from 5 lanes to 6 lanes. Sure, whatever. To saying that there is a small village which is not connected to a port in India, and you put in paved roads which take you from the village to the port, which is a massive increase in productivity, because suddenly where you could do no trade, you can do as much trade as you want, because now you've got a paved road. So the second one has a massive impact on growth. Going from 5 lanes to 6 lanes is actually going to have an extremely marginal impact on any immediate, on future GDP growth. Near term, yes, because, you will hire construction workers, et cetera, et cetera. And don't get me wrong, the infrastructure should be rebuilt. But ideally, this again is something which gets done at a time that the economy is not already bursting at the seams with supply bottlenecks right, left, and center, because this would be just one more demand on those same supply bottlenecks.
How do you view the commodity price pressure, Sonal, in the scenarios that you're expecting in the short and medium term?
So I would say that on the commodity price front, what we are seeing right now is perhaps not very surprising. It is a combination of the fact that the world, after having essentially shut itself down, is in various phases of reopening. So that is the one side of things. At the same time that we do have literal bottlenecks at everywhere from ports onwards, which means that supply chains have been somewhat disrupted, which is another factor in commodity price pressures. And then if I look at something like oil in particular, actually regulatory changes in the US have resulted in the quantity of production from the US going down. And that in turn, of course, does mean that the US will need to import more. So, you've got a combination of demand and supply factors, which to me would imply that we will continue to see some commodity pressures in the period going forward.
And so would it be unfair maybe to put you in the spot with this one? If you were to look at the 3 buckets, equities, fixed income, and commodities, over the next 2 to 3 years, what do you think is going to look stronger?
So I would actually, I'm not ducking the question. It is a difficult question, but I'd say 2 to 3 years is a long period. So what I'd say in the first part of the 2 to 3 years, fixed income looks the least attractive of the 3 buckets. So if I'm talking about the next 6 months, I'm talking about the next 12 months, I don't see fixed income as being particularly attractive relative to equities and commodities. But as I go further forward into this 3-year period, I think that fixed income starts moving up in that ranking. And I do think as we near the end of the 3 years, I think equity starts taking at least a middle to back seat in relative terms, because I think the cycle at some stage will have to conclude. So towards the end of this period, I would put that into the shape. Commodities, I continue to see being well supported as we continue to be in the growth phase of the cycle.
Sure. Okay, just a sort of a big picture view as an economist, how concerned are you about the way COVID will change an economic policy approach? Yes, there'll be these booster packages like we're seeing in India and elsewhere. We're talking about them. But how do you see an overall shift due to the pandemic in an economic process?
I think that it worries me a little bit, because I tend to believe that the more a government continues to play a larger and larger role within the economy, the easier it is for mistakes to be made. And I think that massively state-directed economies which are successful are few and far between. You, of course, have China, which by many metrics is super successful, but you also have a long track record of countries which have failed in their attempts to manage every aspect of controlling the direction of investments, of pushing out larger and larger, having the government having a larger and larger footprint, so to speak. It tends to have negative longer-term growth impact. You have less private investment, the more government investment you have. And private investment is actually at the heart of a lot of true dynamic growth. And so it worries me. I have actually some hope in some ways that if you do see stronger inflation for a period of time, there will be a scaling back of what I see as this massive expenditure expansion, debt expansion by governments around the world. And, there will be a sobering up, so to speak, in terms of not being able to write unlimited checks with no consequences. So something to worry about, but hopefully it will go in the right direction.
Would this in any way mean that there could be instances of higher volatility in the market? I mean, to be honest, who had expected that in the middle of the pandemic, the way the markets have been across many large economies, that it would reflect any sort of a fundamental pressure on businesses? So I'm just curious to know how much of a volatility are you expecting going forward?
Massive amounts. I mean, seriously, I would expect volatility. Again, I'm speaking wearing my fixed income hat, and I would just note that we have seen US Treasuries, one of the largest, deepest markets in the world. We have seen a 40 basis point rally in 3 weeks. 30 basis point sell-off in 2 weeks. This is unheard of. This is massive quantities of volatility, which in my mind comes less from the pandemic and much more from policy, right? So if you have a lot of liquidity, you have a lot of people chasing the same assets, valuations become super stretched. If, for example, you were in a situation where you knew you had bought a very expensive asset, it keeps rising, you're very happy. But as soon as it looks even a little bit wobbly, you want to take your profits because you don't want to risk the possibility that somehow the entire house of cards will fall. So I think that looking at fundamentals is important, but it's a pretty in both directions. I think it's a little dicey because you could see surges, but you could also see big drops because valuations are increasingly being driven, certainly in the developed world, by policy as opposed to fundamentals.
Indeed. Thanks very much, Sonal. Such a pleasure chatting with you.
It's such a pleasure chatting with you too, Shaili. It was really, really fun.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.